Canada's reputation for stability often sounds accidental: polite politics, cautious banks, a country that somehow avoids the worst when markets implode. But here's what nobody tells you. Canada didn't survive repeated market crashes by being lucky. It survived by being structurally boring in a world addicted to speed. This is where the pattern begins. Not with brilliance, but with restraint. In 1929, global markets collapsed and wiped out decades of wealth. In 1987, stock prices plunged in a single day. In 2008, the world's financial system came within hours of freezing entirely. Each time, Canada was hit. Each time it bent instead of breaking. For anyone today watching volatility return, leverage rise, and confidence thin, the real question isn't why markets crash. It's why some systems absorb shocks while others fracture. Canada's exposure has never been small. Its economy has always been tied to external demand, global capital flows, and commodity cycles. That makes resilience harder, not easier. When the Great Depression hit, Canadian GDP fell sharply. Unemployment soared above 25% in some regions. Banks failed elsewhere across North America. In the United States, thousands of institutions collapsed. In Canada, none of the major banks did. Not one. Everyone thought they were safe until they weren't, except in one system that quietly refused to play the same game. Here's the mechanism. Canada entered the 20th century with a concentrated banking system. A handful of large, nationally regulated banks dominated the financial landscape. Critics called it anti-competitive, too conservative, too centralized. But concentration did something fragmentation couldn't. It spread risk. Banks couldn't gamble regionally and disappear. Losses in one area were absorbed by profits in another. Lending standards mattered because failure was visible and reputational, not innovation. Survival. This structure was tested repeatedly. During the Depression, Canada's banks tightened credit aggressively, worsening short-term pain but preserving solvency. At first, it looked like cruelty. Then the bill arrived, in the form of long-term stability. The danger wasn't what people saw in the moment. It was what they ignored elsewhere. Systems built for speed collapse faster than systems built for endurance. Fast forward to 1987. Global equity markets crashed in a single day. Panic rippled through trading floors. Canada's markets fell hard, but the financial plumbing held. Banks were not deeply entangled in speculative trading. Household leverage was lower. Financial innovation had not outrun regulation. Not because Canada feared markets, but because it distrusted excess. This pattern hardened over decades. Regulation in Canada evolved less from ideology than from memory. Policymakers remembered the cost of collapse. Banking culture rewarded longevity, not quarterly dominance. Mortgage lending followed conservative rules. Down payments mattered. Recourse loans tied borrowers to responsibility. Here's why this matters. Systems that assume rational behavior design differently than systems that assume optimism. By the early 2000s, this restraint looked outdated. Financial engineering exploded elsewhere. Securitization, derivatives, and leverage promised higher returns with lower risk. On paper, Canada watched and participated cautiously. Its banks engaged, but under tighter limits. Housing prices rose, but underwriting remained stricter. Everyone thought Canada was falling behind. It wasn't. It was waiting. Then came 2008. Global credit markets froze. Iconic institutions collapsed in days. Governments scrambled to prevent total failure. Here's what nobody tells you. Canada didn't need emergency bank bailouts because its banks never lost solvency. Liquidity support was provided. Confidence was reinforced. But the core system held. Not because risks didn't exist, but because they were capped. At first it looked like luck. Then the structure became visible. Canada's mortgage market lacked widespread subprime lending. Banks held loans on their balance sheets instead of offloading them indiscriminately. Capital requirements were higher. Supervision was centralized. The danger wasn't absent. It was contained. This is where the pattern becomes clear. Resilience is rarely exciting. It looks inefficient until catastrophe reveals its value. But stability has a cost. Tighter credit slows booms. Concentration limits competition. Housing shortages can worsen when supply is constrained. Canada accepted these trade-offs repeatedly. Not perfection. Preference, not maximum growth. Managed risk. Here's the trap. When stability becomes identity, complacency can follow. Success breeds confidence. Confidence tempts relaxation. By the 2010s, new pressures emerged. Housing prices surged. Household debt climbed. Global capital poured in. Analysts began to ask whether the old safeguards were eroding under new conditions. Everyone thought the system would always hold. They weren't guaranteed. And that unresolved tension is where Canada's story pauses. Because resilience isn't a fixed trait, it's a choice that must be renewed under pressure. The same mechanisms that protected Canada in past crashes now face tests they weren't designed for originally. Whether discipline adapts or ossifies is the question history hasn't answered yet. Canada's ability to absorb past crashes created a dangerous illusion that stability is permanent. Here's what nobody tells you. Resilience only lasts as long as the incentives that created it remain intact. Once those incentives shift, even the most cautious systems begin to strain. This is where the pattern deepens, from survival to stress management. After 2008, Canada emerged with its reputation enhanced, but its margins thinner. Low interest rates lingered. Asset prices climbed. Households borrowed more. The system that had avoided collapse now faced a subtler test. Can restraint survive success? Here's the mechanism. Post-crisis monetary policy made capital cheap everywhere. Canada was no exception. Housing demand surged, especially in major cities. Prices detached from incomes. Debt rose steadily. Analysts suggest that what protected Canada in 2008, tight underwriting and bank capital, did not eliminate risk. It transformed it, not explosive failure. Gradual accumulation. The danger wasn't what people saw. It was what they normalized. Unlike systems that collapsed dramatically, Canada's risks built quietly. Mortgage terms lengthened. Investors entered housing. Immigration increased, demand faster than supply could respond. Banks remained well capitalized, but exposure concentrated. This wasn't recklessness. It was adaptation to a new environment. But adaptation carries trade-offs. When shocks arrive slowly, discipline erodes without anyone noticing. If this pattern applies, Canada's lesson is not that crashes can be avoided forever. It's that their form changes. One scenario suggests that strong regulation can turn sudden collapses into prolonged adjustments. Another indicates that delays can increase social pressure even if financial systems remain intact. Stability becomes less about avoiding failure and more about managing friction. Here's the trap. Other countries look at Canada and try to copy outcomes instead of structures. They consolidate banks without strengthening supervision. They tighten rules without cultural buy-in. They assume restraint can be legislated overnight. Canada's model worked because it evolved over a century of memory and consequence, not policy alone. Practice. Here's why this matters now. As global volatility returns, systems will be tested again. Some will fail loudly. Others will grind under pressure. Canada's history suggests that boring systems endure, but only if they keep choosing restraint when speed looks tempting. The moment caution becomes complacency, resilience fades. Canada didn't navigate past market crashes by predicting them. It survived by limiting how much damage any single shock could do. Not brilliance. Boundaries. Not foresight. Structure. The lesson isn't that crises can be eliminated. It's that their impact can be contained, if discipline is maintained when it feels unnecessary. Whether Canada can continue to make that choice under modern pressures remains unresolved. And that unresolved tension is the real takeaway. Stability is not an achievement. It's a commitment that must be renewed every cycle or quietly surrendered.